ऑनलाइन सही है।
Right. Good afternoon, ladies and gentlemen. Thank you very much for your attention. I know it's a bit late in the afternoon after, I guess, we've had our lunch and desserts. But, I think we have a very sort of, I would say, interesting session lined up with a lot of, with three very eminent speakers, eminent and very knowledgeable in their own spheres, in their own sort of professional areas. I'm also told that, and the clock is ticking right in front of me, it says counting down from 30 minutes, so that's as visual a reminder to be on time as possible as it could be. So in the interest of time, I'm just going to get right to it. But before I do, just a really one-line sort of introduction of my panelists who are here, starting with Ajit. Ajit, you're obviously the strategy lead for the government and the public sector at EY. You've also been a very prominent person in the public policy space previously. So I think from you, I'd be looking to hear your insights in terms of how capital markets can play a role in this green transition. We also have Nitin Gupta, who's the co-founder of Attero. I hope I'm pronouncing that right, which has actually been, which operates, I would say, in the circularity business broadly, and has been doing so for quite some time. It's not a recent entrant in this space, so maybe a first mover, if I could say so. And then we also have Nilesh Shah, who's the managing director of the Kotak Mutual Fund. Nilesh, I hope we are audible and visible to you, because I'm not sure if I can't see Nilesh on screen. Okay. Yeah. Hi, Nilesh. I hope we are audible and visible to you.
Hi, Gagan. I am able to hear you.
Right. Great. Thank you, Nilesh. Thank you for making time. In fact, Nilesh, before I begin answering the questions, I got to say I have a very vivid memory of you speaking at a Gift City event, I think a year and a half ago. And some of the comments you made, I still remember. So I'm looking forward to picking your brain further and building on some of those topics as well as other topics. But so yeah, thank you for making time. Ajit, maybe I'll just begin with you. So green financing spans mitigation, adaptation, as well as financing for other environmental sort of initiatives. At the sort of mitigation end of the spectrum, I would say amongst the three, mitigation, adaptation, other environmental, the financing pattern in a way is pretty well established, and it's really been dominated by and large by banks and NBFCs, mainly domestic. But if we look back to some of the keynote speakers or the speakers earlier, and again, from a policy perspective, adaptation is really important as well. So what I'd like to ask you is, how can the capital markets, particularly the debt capital markets, because after all, we are here talking about unlocking the capital markets to power the green transition. So how can the debt capital markets, or maybe even the broader debt and equity capital markets, play a role in unlocking capital flows for adaptation? So over to you.
So I think, thanks so much for that question. Thanks so much for that question, Gagan. It's a very relevant question, especially when you draw the distinction between mitigation and adaptation. So we'll come to that a little later. First, the good news. The green bond market is one of the fastest growing investment classes that there is in the world, growing very, very rapidly. Total outstanding, we would say about $1 trillion. Last year, issuance a couple of years ago, of almost 400, 500 billion is the range of that. And the other issues that have happened right now with that bond market and the green bond market that were there in the early phases of the green bonds trading at a discount, which means a higher yield than the regular market, also seems to have dissipated. So on the demand side, things are looking good. Your yields, actually, you're getting a greenium, a slight premium on the bond, which is that the issuers are able to issue it with a lower cost of capital than regular bonds for similar risk. But why then is it relevant for us to be asking the question you're asking, which is that not all projects, because of the relative scale, are eligible for the size of this bond market. Bonds require a certain economic size, a minimum size, and especially in a market like India, we'll talk about the global market a little later, but our regular bond market hasn't evolved enough, it's not liquid enough. While it's been growing nicely, it's still majority a private placement market. And the issue that the risks that remain for a green bond is in a illiquid market, where in India it's still fairly small compared to the global market, the penetration. You don't have enough trading liquidity, so the risks are slightly higher, and the market, thus is going slower. So there are three, sort of solutions to address this. At the global level, of course, the growth has happened, the deal sizes, you've been coming down in terms of the size of transaction that can get financed using bonds because the liquidity is improved. But in India, there are various solutions that we can look at, especially when you're shifting from mitigation to adaptation and the size of projects. And one is, create instruments of pooling. So you take multiple projects, you pool them together, and there's a fund that actually is the one that issues the bond, and it's not the actual each project that issues the bond. So that's one way to sort of expand and accelerate the market. Now, whenever a market begins, usually you'll see the way the classic capital markets are structured. That it's risk equity that goes in first, the risk debt comes in later. Similarly, when you're looking at it over here, it's the riskiest capital that goes in first. Then you watch the banks, NBFCs that do the sort of secured lending, doesn't matter what the project is. And then finally, the bond markets develop and get to a stage where they can do it. So now when the big capital has to be deployed, some of these solutions we talked about, I don't think the equity markets for green financing, for entrepreneurship, need too much assistance. The risk is fairly balanced, in many ways. Of course, you'll have greed come, and then you'll have fear come, like we are seeing in the capital markets now. That'll happen with green, just the way it'll happen with other innovation. But in the bond market, there is a lot, like some of the solutions that we have talked about that we can use to start accelerating the improvement in this area, bringing down the cost of capital. And that is, pooling, which will make bonds more equally. What I would call credit enhancement that the government can do, the private sector can do by creating funds that will de-risk these projects even further to make these green bonds more attractive. So there are various other instruments that can start accelerating that. I hope I addressed the question.
Thank you. No, thanks, Ajit. And I think, pooling, cost of capital, credit enhancement, all areas that we at CEEW, of course, look at and work on quite deeply, particularly on the credit enhancement side, as a way to shift paper, which, by itself may not be able to access the bond market, given the way the domestic bond market operates. So thank you for that. And actually, I'm going to shift very quickly to you, Nilesh, and ask you, on this point of green paper, particularly on the capital market side, sometimes it's described, or the challenge is sometimes described as, not enough demand and not enough supply. So, the guys who are looking to sort of issue it, they say, well, there's not enough demand for this paper. And the folks who are, sitting on the sidelines, the buyers, the folks who are looking to buy this paper will say, where's the supply? Sure, there's been the sovereign green bond issuance. But if you look beyond that, particularly in the domestic debt capital markets, interestingly enough, a lot of the issuances in the past actually have been green bond issuances, USD or whatever currency overseas, because they have a much deeper high yield segment, right? So I think the question to you, Nilesh, particularly since you're on the buy side, is how would you view the idea of green investment mandates for the large institutional investors? What's your thinking around that as a way to kickstart the market, and your thoughts in terms of how these could be practically structured? Very broadly, if they were to be brought about, how would you go about, and what advice would you give to the policymakers?
So thank you for inviting me over here and giving opportunity to be present on virtual basis. As any buy-side investor, our job is to ensure that return of principal as well as return on principal is doable. As of today, most of the fund flow in domestic mutual fund industry is coming at the short end of the curve, which is liquid funds, money market funds, short-term bond funds. And unfortunately, infrastructure financing, green financing is more long-term in nature. So there is a huge asset liability mismatch. Now, as a buy-side fund manager, one could take a risk on asset liability mismatch with interest rate view and with liquid markets. While interest rate view is positive at this point of time on rates coming down over a period of time, the liquidity in secondary market is virtually absent. The bond market does not have enough depth through which buying and selling or trading in infrastructure bonds can happen. And post what happened with Franklin Templeton during COVID time, no fund manager wants to take high asset liability mismatch risk. So my feeling is that we will be probably there to participate at the short end of the curve, and our participation at the long end will be possible only when bond markets are liquid. From a credit point of view, clearly the focus will be to invest into projects which have predictable cash flow rather than which has execution risk or which has contractual risk. Couple of financing which we have done is through securitization, where receivables were securitized. That was more of a predictable cash flow. But very few project risk we have taken. So to summarize, we are more likely to be at the short end of the curve till such time bond market becomes liquid, and will be more focused on predictable cash flow where return of principal and return on principal is more guaranteed or assured rather than where there is a project risk or a contractual risk.
Thanks. And just a really quick, just a 2-minute follow-up, Nilesh. So if tomorrow a regulation or directive came about that XYZ category of institutional investors had to allocate Y%, X% of their AUM to green, what reaction would you have as somebody who's sitting, on the mutual fund side of the business?
So whatever is the law of the land will have to follow. But if you are asking me to put 10% of my portfolio in, let's say, quote unquote illiquid, you also have to give me similar flexibility on my liability side. If I can't sell, how will I repay?
Got it. No, thank you. Thanks. That's very clear. Nitin, let me shift to you. Again, sticking on to this capital market, theme. What I want to ask you is, to what extent is scrutiny from capital market investors, in your view, sort of driving circularity among the companies, that you engage with or perhaps, deal with? Companies that are increasingly sort of integrating this aspect of circularity into their operations. And a second follow-up is, do you think, on that note, is any difference between the approaches of domestic and international capital market investors in this regard? So, how to what extent is investor sort of scrutiny driving that circularity, and domestic and international investors, are they viewing it differently?
Sure. So thank you for inviting us and giving us the opportunity to share our views. In my opinion, see, the institutional investors, both domestic as well as international, are forcing a lot of their investee companies to look at ESG in a more holistic standpoint, and rather than only doing it on paper, doing it in a sense, right? So that's driving some bit of circularity within the portfolio companies of various fund managers. Obviously, this is driven more by, let's say, ESG thematic fund managers rather than simple fund managers. But overall, that's the sort of outcome that we are seeing, right? Just taking a step back and sort of also peeling the onion for a couple of things that you earlier asked to, as well as, see, in the equity capital markets, this entire energy transition theme that's playing out, in this, the green companies or circular companies or companies operating in that space get to play the story that this is a macro that's playing out. There's a huge market opportunity there, which equity investors are willing to price, and the equity capital markets are easy to tap into, right? From a debt capital markets perspective, as was elucidated by previous speakers as well, it's still a little tougher in India, largely because the asset liability mismatch, largely because, let's say, the energy transition infrastructure build out is a long-term play, whereas the funds available mostly are for short-term liquid assets in place, right? So at least in our opinion, today, majority of the non-green companies do not factor in the total cost of business. That is leading them to have supernormal profits compared to, let's say, green companies. So as an example, take mining as a sector, right? Globally, close to around $1 trillion is invested in capex in mining almost every year, okay? Mining creates a huge amount of pollution. It creates a huge amount of all kinds of water pollution, soil pollution, even social pollution, right? To give you context, if you look at a traditional lithium mine, to extract lithium, let's say 1 ton of lithium, using traditional lithium mining, it requires more than 500,000 gallons of water. Now you can imagine that the places where this mining is happening, what happens to sort of those societies that remain in those places. So there's a whole lot of costs that are not factored into the mining company's P&L, but are borne by the society at large. So any fund manager or any, let's say, bond manager investing in that particular mining company does not care about those social costs, right? So one way to look at it, at least in my personal opinion, is start to take into account the total cost of that business and ensure that certain profits that are sort of being commanded because the total costs are not into picture are used for a first loss guarantee program for energy transition, okay? That way you can solve both the problems.
Got it. Thank you. Thanks, Nitin, for that. Looking at the clock, I feel like I'm in some sort of a sprint panel discussion. So let me make the most of the remaining 10 minutes or so, and ask all three of you to just keep it under 2-3 minutes each, please. But yeah, getting back to you, Ajit, a taxonomy, a climate finance taxonomy is in the works. It was announced in the budget over the summer. How important do you think a climate finance taxonomy is going to be in driving climate finance flows from the domestic capital markets in India? And to what extent do you think that climate finance taxonomy should feature or have elements of interoperability with globally recognized taxonomies?
So I think, thanks for that question, Gagan. So it's actually quite critical that taxonomy is designed right. And there are some elements to how taxonomy is defined that become relevant when you have a look at the different stakeholders. So when we talk about climate finance, when we talk about ESG, when we talk about SDGs, they're all talking about different clubs of principles. And each one of them has different stakeholders. So when you're designing a taxonomy, when you separate, you're able to target market segment the stakeholders in a far cleaner manner. It makes it much easier to reach the market, both on the supply and the demand side. Now, one of the things that when India was the president at the G20, that we proposed and came through with the group that I was, knowledge partner for, where EY was knowledge partner, was financing for global economic recovery. One of our suggestions was to create a global SDG acceleration fund. But this acceleration fund was only going to be focused on what we would call global public common goods. Because the West felt they had all this debt, they're having a tough time, they have a slow economy, Why should they be funding the developing world? And the developing world felt the cost of capital is too high because of a broken rating system for bonds, where per capita GDP or ability to pay was a proxy for their credit rating, which is the actual payments. Well, we know that the biggest defaulters in our Indian banking system were sometimes the largest balance sheets, right? And the same in the world. You have Argentina that 3 times was able to default on its bonds and could price 100-year bonds cheaper than India. So in that regard, whenever you go in for a pool where you're going in for global capital and you want it to be in self-interest, does Germany really care whether the carbon capture is done in Germany itself or it's done elsewhere? It's very fungible where it happens. Whereas when you go into some other parts of green finance, it's more local when you're looking at pollution, local pollution. So the moment you get that taxonomy right, and we know the funds are ESG funds, you've got your climate funds, you've got, these 4, we've defined 4 particular global public government goods. You can get global funding at the cheapest cost for that, and they are completely neutral to where it is when it is a global public government goods and if it's globally fungible. So that's one of the examples I gave. But the taxonomy is critical both in India and to be globally interoperable, because otherwise how do you get it at the rates that you'd like?
Got it, yeah. So if you're making it, you might as well make it in a way which is somewhat interoperable so that you kill 2 birds with 1 stone or whatever, right? Okay, no, thank you. So moving to you, Nilesh, Ajit talked about a greenium. Some people say there's not a greenium. And whenever this topic of greenium or concept of greenium comes out, we're talking or looking at it from a debt capital markets perspective. And even if it does exist, probably it's not much. But if we were to shift our gaze to the equity capital markets end of the spectrum, if we were to shift our gaze to the equity capital markets end of the spectrum, a lot of the green play stocks in the Indian equity markets seem to have done a lot better than their conventional peers, right? So in a way, you have investors who are looking to pay a larger price, or maybe another way, accept a lower earnings yield on these stocks, right? So what do you think explains that sort of divergence on a greenium or the lack of a greenium when it comes to fixed income, but perhaps real interest in green when it comes to equity?
So like any other market, investors wants to make money. Fortunately for India, renewable energy was the focus. Government puts all its might behind renewable energy. Subsidy schemes were drafted. Ease of doing business for renewable energy was done. Unlike thermal power plants where PPAs were not signed, for solar power PPAs were signed much faster and easier. All these things resulted into better risk return opportunity for equity investors in renewable energy space. Will there be a down cycle and will investor appetite come down? Undoubtedly. So most important for raising capital will be to assure investors that they are going to make money. In debt, green financing requires discount rather than market price, and hence investor appetite is lower. On the equity side, thanks to the government's encouragement, there is a premium and hence equity investors are happy to invest. We'll have to balance the risk and return for investors to get both debt and equity flow. And one limited point for the world to copy is the Montreal Accord. When ozone depletion gases like chlorofluorocarbon was a problem, the world came together where developed world provided technology and money and developing world started complying. Why can't we do the same thing for green financing, as Ajit mentioned, for common goods? Let the developed world take some responsibility for all the damage they have done to the environment and provide technology and capital. And the developing world then can create compliance and overall will have a better outcome.
Right. No, thanks for that, Nilesh. So Nitin, equity markets, shares, bonds, when you're looking at it from a even I would say infrastructure investment trust, right? So neither equity nor debt, but unit trust, right? When you're looking at it from the circularity point of view, at that end of the spectrum, which is, by the way, I think doesn't sometimes get enough headlines, but from what I heard, the finance secretary talking about energy efficiency. So I think that's efficiency on the energy side. Circularity is looking at efficiency on the physical physical assets and materials that go into building these things, right? So I think that is going to come increasingly into focus if I were to just draw the dots between energy efficiency to circularity. From a circularity business perspective, are there any other instruments that you know about or you think could come into play beyond plain vanilla equity, plain vanilla debt? Some sort of hybrids or something you think that, your peers globally benefit from in terms of being able to access capital? Or maybe you think that, equity, debt, and whatever, exists today is adequate. It's just about being able to tap it in the right way.
No, thanks for that question. See, today, at least in my opinion, there are enough and more structures out there from a creativity standpoint, which sort of look at both risk from a debt perspective, return from an equity perspective, and marry both of them and come out with structures that can meet the requirements of the capital seeker, right? Internationally and in India, one difference that I do see is internationally for a lot of green projects, the regulators or the local governments are willing to put in a lot of risk capital, which in India is absent, right? Now, that might be due to the fact that we are still a developing country, but that's one portion of capital that's absolutely not present in India. Let me just take a step back and also address the thing that you asked about greenium, right? So at least from an equity market standpoint, the fact that Nilesh bhai also pointed out that there is a story to be played out, there is growth to be played out, the entire energy transition is happening, the equity markets understand growth and they're willing to pay for growth. Right? On the debt side of the business, because all investors need to make a certain minimum return on their capital, cash flows are very important, right? Now, one example I can give you on how this is matched in the recycling industry or the circular industry in India, Government of India introduced something called an extended producer responsibility legislation. Under EPR, the government actually mandated that producers which sell electrical and electronic products in the country are required to take back e-waste and ensure they're scientifically recycled, right? So EPR came as an additional revenue stream, which was predictable, which was sort of contracted long-term with blue chip counterparties to recyclers. That enabled recyclers to tap the debt capital markets as well, right? So that's a financing mechanism using a tool which is very local in this country, but obviously implemented globally as well in different forms and spheres, which enables cash flows.
Right. Thanks, Nitin. So actually interesting that you brought up the point on greenium as well. So maybe, I know time's up. That's a big red sign that says time's up. But on the greenium bit, maybe, food for thought that by focusing only on the debt capital markets in our search for greenium, maybe we've been looking at the wrong place. Maybe the equity markets was always the place to sort of look at greenium in the first place. But yeah, I think that's about it. That's all the time we have. And yeah, thanks a lot. Thanks for the...
Thank you, Gagan. Thank you very much. The best thing about any discussion is that we should have, some more stuff to discuss, and so that we can have another round of discussion. Thank you, Gagan. Thanks a lot. May I request Richa, if you can come forward. Richa, Malik, can you come forward? Thank you, Nilesh. Thanks for joining us from Mumbai. Ajit had to step aside because he had some call which he couldn't defer. Thank you, Gagan, and thank you, Nitin, for sparing your time and giving us a real good deep dive into unlocking the capital markets to the power green financing. And to all those interested, CEEW is taking this discussion to National Stock Exchange on May 12th. Where it will be dealt more in a more deeper way with a lot of capital markets experts in Mumbai. If some of you are interested, you are most welcome to connect with CEEW. and they can give you more details about it. So let's get into the real conversation about